In this video, I'll guide you through the correct way to use this indicator, explaining every single aspect of it along the way. By the end of the video, you'll have a clear understanding of how to implement the cumulative delta into your trading strategy to boost your profitability like never before. Let's take a moment and get everyone on the same page as to what the cumulative delta really is. It's a tool that shows the difference between trades transacted at the bid and the ask. It is seen cumulatively over a bunch of prices. So, if 5 trades are executed at the bid and 10 trades executed at the offer, the delta would be plus 5. So, why is this important? Well, order flow is the most essential element of short-term trading because it shows exactly what is going on in the moment rather than what may happen. It is not a lagging indicator, unlike all other indicators. Now you can either choose to simplify things by using the cumulative delta, or you can choose to complicate trading even more by watching the DOM, depth of market. In order to look for these patterns, now that you have a grasp of what the cumulative delta is and how it is computed, let's delve into the top techniques for utilizing it. There are 3 critical patterns that emerge here, with 2 of them being the most vital in my playbook. When the price moves in tandem with the cumulative delta in the same direction, this indicates aggressive buying or selling, which is indicative of a strong trend or a healthy market. Another crucial pattern is when the cumulative delta makes a new high or low, but the price does not, which implies that there is an absorption of the sell or buy market orders at the bid or the offer. Unfortunately, this is one of the most misunderstood and misinterpreted patterns, with a lot of misinformation circulating about it. Numerous traders believe that it can forecast an upcoming movement, but that is pure nonsense, because it does not work that way.
This is all wrong.
They believe that if the market is selling off, but the delta is rising, it implies a potential reversal. However, it only indicates that thousands of sell limit orders, icebergs, and hidden orders are absorbing the market buy orders. As you may be aware, the market consists of market orders and limit orders, with limit orders contributing the majority of liquidity to the market. This is because big players employ these orders, which is why you should focus primarily on this aspect. Focus. The third and final pattern arises when the price hits a new high or low, but the delta fails to confirm it. Essentially, this is the opposite of the absorption pattern mentioned earlier. In this scenario, the price is leading rather than the cumulative delta. There are 2 possibilities here. Either the high or low is weak, or there aren't many bids or offers trying to hold or push the market. Based on my extensive experience, I have observed that in most cases, this indicates a weak high or low. But what exactly does a weak high or low signify? In this case, although the price has hit a new low, the cumulative delta fails to validate it, indicating that there were not enough market sell orders to sustain the move, or they may have spotted support on the depth of market at a lower level. As a result, the price reversed, and short positions were caught in a false breakout, forcing them to buy and become buyers themselves. It is crucial to focus on pivots or support and resistance levels. By identifying strong pivots and divergence or convergence in the cumulative delta, you can find exceptional trading opportunities. However, it is important to note that there is no such thing as an infallible trading system that will guarantee a win on every trade. You must be prepared to accept losses to succeed in this industry. The key is to maximize profits when you're right, and strictly adhere to your stop-loss orders, which should be kept to a minimum. Now, I will reveal my personal approach to trading along with practical examples of how I consistently make profits each month. First, I analyze longer time frames, such as the 2-hour chart, to gain insight into the current market sentiment and identify strong pivots, those that have seen multiple rejections or retests. From there, I create a plan for the day on the 5-minute chart to anticipate potential scenarios and how to respond. I consider what I will do when price reaches certain levels and look for divergence or convergence in the cumulative delta, as well as a hammer, inverted hammer, or doji candle. To enter a trade, I place a limit order within 2 points of the candle low to keep my stop loss narrow. I wait for a move in the intended direction and add to my position during retracements. I adjust my stop loss to break even or slightly below for minimal loss with significant potential for profit, aiming for at least a 1:6 risk to reward ratio, with some trades even exceeding 1:15. By following this method, you can replicate my success.